And when we raised our Series A, we got a lot of pressure from people around us to take the term sheet with the highest valuation. And I was really stubborn about that. I prioritized partner over valuation. And in 2023, I'm so glad I did, because a lot of these valuations didn't hold in the new market, right?
This is Funded, a show where founders who raised millions in venture capital share the gritty side of what it actually took to get that money in the bank. I'm Jason Ye. Not too long ago, I was trying to get my ideas funded. And back in the day, I was a VC listening to founders pitch me for money. If all you've ever known is running a bootstrap startup, the world of venture capital can feel intimidating. Bootstrapping a company is really hard, and you have to learn a ton to survive. Going down the path of venture funding is equally hard, but in very different ways. It takes new skills to be successful in that arena. You might have been able to build an amazing company on the first path and think to yourself, with some outside capital, this could be huge. But without understanding how the game of venture capital works, you're at a massive disadvantage. Today's guest, Analisa Goodin, founder and CEO of Catch+Release, knew this and decided to be proactive about it. Way before she went out to raise her first of 3 successful rounds, she became a relentless networker and student of the game of venture capital through conversations with VCs. Clearly something clicked, because Catch+Release has now raised over $31 million in venture capital. Analisa's strategy could be described as being pretty creative, but it didn't come out of nowhere. It was already deeply embedded into who she was from an early age.
Yeah, I would say that as a kid, looking back multi-generations to my parents' parents, I was always exposed to 2 different frameworks of how to see the world. One was highly creative and the other was highly logical. My dad's a neurologist and a mathematician, but he's also a really skilled poet. So he always had these 2 sides to him. My mom's a photographer, but also a very skilled architect. So really logical around space, but highly creative around vision. My grandparents were the same. A lot of artists and urban planners and academics. This kind of blend of creativity and logic was really kind of at the forefront for me. I was the oldest of 3 kids. So natural leader, I guess you could sort of say. I wasn't older by much, just 18 months apart from my younger sibling. But I think I loved that role, both from a leadership perspective of, having responsibility from an early age, but also being the first to break the rules. I was the one that sort of defined the boundaries of what was acceptable from my parents' perspective and what wasn't. So my younger siblings sort of saw the mistakes I made and chose to either repeat them or learn from them. But I liked being in that position. It was fun.
Yeah, and it sounds like you didn't say the words, but the leadership stuff, breaking the rules, more of an extrovert than an introvert?
Yeah, I definitely was very extroverted as a kid. ADD, very kind of stimulated by my surroundings, especially by people, very social, highly distractible. Yeah, very engaged, very curious. Yeah. I was a really curious person, especially curious about other people. People always fascinated me.
So you talk a little bit about the dual mindsets of your role models, your dad, your mom, your grandparents. I don't want to put words into your mouth, but I look at your background and where you ended up going down, what side of your brain you started following as you got out of high school. Do you remember kind of where you thought you were going as you were coming out of high school?
Yeah, I highly creative, had an amazing art teacher. I was surrounded by the arts as a kid, so it wasn't new to me in high school. I just had a really amazing art teacher in high school who really empowered me to think that that's something I could do for a living. And so when I went to college, I decided to do an undergraduate in fine arts. And I didn't know necessarily what that would lead to from a sort of a professional career perspective. Obviously, I wasn't naive in the sense that, artists don't make it in the art world necessarily just because they're passionate about their medium and their body of work, the art world is its own beast, in some ways even separate from making art. Being able to survive in the art world is almost a different skill entirely. And so I wasn't necessarily thinking about that, but I trusted that whatever I did, as long as I was passionate about it and engaged in it, it would lead me to a place that I'd want to spend time as a career. So I had a lot of trust, I guess, in myself and in the path that I was on, even though I didn't know exactly what I wanted to do. A contrast to that would be my husband, who I've known since I was a kid, actually, but we didn't get together until college. He always had a really specific idea of exactly what he wanted to do. He's an amazing designer, an entrepreneur, but he knew from freshman year of high school that was what he wanted to do. And I always felt a little sort of like, man, am I just like flailing around? I don't have this sort of path that's clear. Is that okay with me? Do I need to find that path? And I remember being a little insecure about it sometimes, but also totally trusted it. And that led to it really, I mean, it really was the sort of like foundation for myself as an entrepreneur, was being in that space of somewhat ambiguity, but always driven by passion and curiosity for whatever it was I was engaged in.
Yeah, and you said your parents came from different backgrounds, scientists and designers and architects, but it didn't sound like you had the North Star of being an entrepreneur at some point, kind of growing up.
Mm.
So
I,
where did that come from? When did you start seeing yourself as maybe venturing out on your own?
well, I think artists are entrepreneurs. I mean, when I think that became especially apparent to me when I had my first studio outside of school. So after I graduated with my BFA, I lived in Italy for a few years, studying abroad in school. Came back to California, graduated. Knew I wanted to go to graduate school, but there was about 2 or 3 years gap between the BFA and the grad work, where I had a studio in West Oakland, rad little studio where I was, went every day to paint and draw and get ready for exhibitions and market my work and do all the things that we do. Um, Very entrepreneurial. No one was setting my schedule. No one was saying, here's how you need to spend your time. It was very much up to me how I spent my time. Um, I had side hustles during that period. So I worked in production as an image researcher, which was eventually what led to me starting Catch and Release, the company. I worked in restaurants to make some money, but I never looked at these jobs, these kind of side hustles, as just a way to make a paycheck. I thought, if I'm going to spend any time outside the studio and give someone else my time, I better be getting something in return that's bigger than just a paycheck.
Right.
So restaurants I worked on were like Michelin star restaurants. I was like, I want to be in a chef's studio. If I'm not in my own studio, I want to learn the art of cooking and the art of service and challenge myself. I just always wanted to be challenged. And I also trusted that as long as I was doing something that I was curious about and that I could be compassionate about and that I was learning from, I trusted that those threads would had a place in my life in the future. I trusted
Yeah,
that I was building a foundation for something. Even if I didn't know what that foundation was going to lead to yet, I knew it was an important part of my own character.
that's very cool. I've heard this comparison before of artists and entrepreneurs and the connection there. And as you spell it out, it totally makes sense, right? Creating a product, you're thinking about your
Yeah, sure.
audience, your consumer, and a little bit about what you want, a
Sure.
little bit about what they want. And then, yeah, there's a full cycle business to it where you create the product, you market it, you sell it, you got to learn
Yeah.
all those things. And
Yeah.
now I totally get that on the entrepreneurial side of things. Now we're going to fast forward to where we like focusing at Funded. And it's really this idea, like, yes, you were an entrepreneur as an artist. I think you started something yourself, but the gap between that and being a venture-backed founder is quite large, right? Doing
Mhm.
something similar, but also something quite different. I wonder if you could
Mhm.
fast forward into the timeline around when you were thinking about this company, Catch and Release, what you wanted to build. And my first question there is, I think you have a lot of opportunities to talk about the business Catch and Release, but what I want to know is, when you thought, I want to start this company, were you like, I want to start this company and I need to raise millions of dollars for this company?
Mhm.
Did you know what it meant to raise capital for companies? Like, tell us a little bit about what your mindset was like when you started Catch and Release.
Yeah. I mean, you're spot on. I mean, even when I surrounded myself with other entrepreneurs at the beginning stages of building the company, I found out pretty early that the kind of support I needed from my peer group really fell into two buckets. Are you venture backed or not?
Right.
And if you're not venture backed, there are some conversations we can have that are helpful, and there are a lot of conversations we can't have that I need to be having, because it is just it's a totally different journey than other forms of entrepreneurialism, no doubt. Some things are the same, right? There's a grind, building something, anything in any way is hard, and there's a lot to relate to someone about on that journey. But when you add venture into it, it's a whole different beast. So I completely agree with that distinction. Um, I didn't know anything about venture capital, born and raised in the Bay Area. Wasn't in the tech scene though. I was in the artist scene. So I knew museum curators and directors. I didn't know VCs and CEOs, let alone engineers, or even how to build any tech at all. But I had a total vision for the product based on spending years and years inside of customer pain in my side hustle as an artist. So I knew what the product needed to be, do, and I knew the customer intimately well. So that was my advantage. But I had a lot of disadvantages. I didn't know how the process worked. So I was a relentless networker. I would take anyone out for coffee who was willing to spend 15, 20, 30 minutes with me. And I would ask them tons of questions about their background. I would ask them about their career. I would try and find patterns in how people became who they were and what it took to get there. It was really more of a discovery period than anything else. I didn't really know what I was looking to get out of it, except for validation that the business idea I had legs. I wanted that for sure. And then getting advice on what the next logical step or best action is to move my vision forward. Eventually, that did lead me into conversations and coffees with people who had exposure to venture. And so I started getting questions. Have you ever thought about raising money? Not really. What does that mean? Then learning that entire world, and then eventually getting introduced to investors, having coffee dates with them, and starting to learn what they're looking for, what the benefits of raising venture are, and what they required from an entrepreneur to even part ways with $500,000 or $1 million or even $50,000.
Yeah, I'd love to pause you right there because I thought we might go in a different direction, but I think this is really important for people to hear you describe this part of your journey because the first thing I'll ask you is when you started in this like sort of information gathering phase of your company building, do you remember how much time you were spending in this phase? And was it this anxiety to get through this phase, or were you just like, look, I'm going to spend as much time here as I need to? Do you remember that?
I do remember it, but I was straddling it with actually building the company. I was already building the company, not the product, but the company. So I was providing a service to my customers. I was really busy. I was starting to build a team of people who were helping me service my customers. And what I was doing in the background was learning what all of the steps were that my customers were taking in the process of servicing their needs, and starting to catalog those in a way that a product could ultimately pick up as a roadmap. So I was using my own business at the time and the momentum that I had with customers as a way to feed the R&D of a future product I would someday build without any engineers on staff or any product people around. So I couldn't spend full-time fundraising. It had to be this thing I did on the side because we had a full-fledged business with customers that paid us. And I knew I wanted to support that business with product and ultimately build something that our customers could use on their own without hiring us. And that was going to take some time, longer than I ever would ever have anticipated, but it took some time. So the fundraising was not something I necessarily was trying to get through. It was something I was trying to validate was the right path for me. I had an advisor at one point say, you're at this crossroads. You could raise money or you could not raise money. You could continue to build this business as a lifestyle business. Here's what that looks like in 10 years. Or you can take venture money and go down this path. It was kind of a red pill, blue pill moment.
Yeah.
It really was. It's like, now this one's highly risky. You take the money, you have the opportunity to build something huge. but there's also high risk there. So like, which one is it going to be? I remember that he specifically laid it out that way.
Wow.
It's fascinating.
Now, I think that's a really good story for people to hear because you came from out by your own admission, you came from outside of that world, right? And
Yeah.
a lot of people who are outsiders, when they get this in the head that they want to start a company and think that they want to start a venture-backed company, they're very anxious to get in and like start with money and start going and start using the money to
Yeah.
build things. But it's helpful to hear like what you had to do, which was like, well, look, I have a business. I'm going to keep running the business. I think I can build more of a scalable product that does what
Mhm.
my current business does. And I'm going to continue taking as many people out for coffee as I can. So parallel track was validating with, people, I'm assuming like people that were building tech, were funding tech,
Mhm.
creating the network that you need. And then until it finally got to this point where people were like, now you do have this choice of raising capital
Mhm.
or not. And it's an amazing choice to be given because it means that you didn't have to raise capital, right? Which is probably
Yes. Yeah.
how you were so successful in the beginning. So that's a great starting point. Um, there are a lot of questions I have.
There's a
What,
downside to that, though. I will
please,
say
yeah,
there's another
share.
side of that coin. So on the one side, yeah, you make that sound so great in retrospect. Like, why wouldn't you go out and prove a market and make money doing it, and then decide if you want to raise money? The other side of that coin, when you start to learn more about venture, is the revenue that you're generating as a service doesn't really matter much in the minds of the VC. So I had problem solution fit. There was a clear market, there were clear customers, but I had no product yet. And so despite the fact that I think I went out to raise my seed round and the company had done maybe $1 million in revenue.
Wow.
Sounds impressive.
Yeah.
Um, got a lot of first meetings with that top line. But that's not enough for the VCs.
Yeah.
Not all of them wanted to take a risk on a pre-product company, right? So it was sort of, you become dependent in some ways on the revenue that you're generating too.
Yeah.
It wasn't like we could just turn it off and say, okay, thank you very much, $1 million. That was fun. Thanks for helping us out. Now we're going to take our margin and just apply it with some VC to a product and ditch all the customers that worked with us over there. You actually have to bridge the gap. And that is a hard, expensive, and fraught with landmines process that not a lot of VCs in the early days wanted to bet on.
Yeah, it's kind of a damned if you do, damned if you don't
Of
scenario,
course,
right?
totally,
And people are like, "Well,
totally.
no, we want you to validate, we want you to get traction and revenue,"
Yep.
and then you give them the
Yeah.
wrong type of revenue. You're like, "Well,
Yep.
you don't get
Exactly.
credit for
It's
that,
so
right?"
true. It's so true. It's so
um,
true.
and so, I
Yep.
think hearing that nothing's easy, right, is maybe one of the takeaways.
Sure.
We'll
Sure.
we'll get back to some of the landmines that you talk about and stuff along the way. Um, but suffice to say, we'll look at Crunchbase. You were able to raise that initial round of capital and then
Yep.
multiple rounds after that. And so there's like a lot that you've learned along the way. I
Mhm.
think where I want to spend, and we could, if we pulled apart every single one of your rounds, like, we could be here for a couple hours. But maybe for now, what we'll say is that you raised your first round, and I believe something like 2017 or 16,
Mhm.
somewhere.
2018.
Okay.
Yeah.
Um, and then you had two big rounds, at least announced over the last 3 years in some of the more
Mhm.
interesting times to raise capital. Okay. So,
Mhm.
where I'd like to fast forward you to is there's a round that was announced, and it's always impossible to kind of tell when this happened versus when it was announced. The announced date was August 8th of 2023, which is kind of right in the middle of a very challenging time for fundraising. And at least what was announced was nearly $9 million. And so I'd like to hear a little bit about, man, 5 years has passed since you raised your first round of capital. Um, you're, you have a very similar period of time to what we've initially described, which is at some point you're running the company and you're like, well, we need to raise money again, or we need to go raise money. Can you tell us around what time that was and what was going on in the company? What was hitting your head? Fast forwarded into around 2023, where you were like, well, we need to raise capital.
Well, we had raised our Series A in 2021. That
Okay.
was our first major round. We'd done seed round, we'd done a post seed round. We were working with many investors that we still work with today. So that's a whole nother topic, which is, who do you take money from?
Analisa touched on something very real here, which is just because you have a successful service with revenue doesn't mean VCs will automatically think you'll be able to create a successful product. If you don't already have a product, you have to get investors excited about the incredible opportunity and convince them that you're the team to do it. When we come back, Analisa touches on power dynamics and the time she turned down a term sheet that would have been a death sentence for her and her company. Like many of you, my last venture-backed startup was a SaaS business. In that company early on, we had the opportunity to sell into a large enterprise, but ran into some walls when they asked us if we were SOC 2 certified. Not only were we not certified, we also found out that it would take our small team a ton of time to get that done, and so we ended up abandoning the deal. If you haven't run into a situation like that where a potential customer or investor is asking if you're SOC 2, HIPAA, GDPR, or ISO 27001 certified, you probably will soon. But unlike me, you could use a company called Vanta to help. Vanta helps automate up to 90% of the compliance work, getting you audit ready in weeks rather than months, and eliminating up to 85% of the costs. Not only that, but Vanta can start small with you and scale up as you grow, helping you land bigger deals and earn customer trust. The best part is, Vanta is offering funded listeners $1,000 off for going to vanta.com/funded. That's VANTA.com/funded for $1,000 off your service. Check it out.
We were given a term sheet in 2015 from a major private equity firm for $3 million. We had $60,000 in revenue at the time.
Wow.
And we turned it down because the terms were audacious. And I got really good advice from one of my advisors that this was basically suicide if we took this money. So tempting to do, but also be very skeptical too, not only of the terms, but of who you work with. So we've been really fortunate that when we look at the time period between raising our Series A and the round we raised last year, a lot of the same investors, we got new investors as well, but we have continual support from our investors throughout the journey of our raises. And that's a testament to us, I think, for sure, but it's also a testament to them. As an entrepreneur, you have to remember you're always in control of who you raise money from.
Yeah.
In one way, VCs are one of the most highly commoditized places, right? Everybody's got money. So who do you want to take money from? And it's kind of remembering that you do have that power, you do have that agency. Raising money can be hard, and sometimes your options might be limited, but you always have the option of saying no and figuring out something else, especially if you think somebody's not going to be great to work with.
Yeah.
So we've always been really picky about that. We raised our Series A from Excel, chose Excel. We did have options, chose Excel because the partner, he and I really hit it off. Still have a wonderful relationship. They participated in the round a few years later in 23, and once we raised our Series A, we knew the trajectory we were on. We knew what we wanted to build and what we were going to try and bring to market. And so raising money is until you're beyond the stages of product market fit and you're optimizing the business and getting to cash flow break even or positive, you're kind of, as an entrepreneur, always looking at, how much time do we have before we're out of cash?
Right.
When do I need to raise my next round? And that's a bit of like, it can be very kind of it can feel a little bit like handcuffs sometimes because raising money doesn't translate directly to how am I delivering customer value. It's really a way to get to the next milestone as a business, but the most important revenue comes from customers. So I think a lot of times because of how hard fundraising can be, we feel this massive sense of accomplishment after we raise a round, and we should feel seen and we should feel validated in that moment by really smart people. But you also have to remember, but that's not really what we're building. We're not building a company to raise money. We're building a company to serve customers. So those are the metrics that really matter, not the fundraising success.
Right. But okay, and I totally agree with that. And one of the things that I observe in your timing is you raised your Series A in 2021, which might have been some of the headiest times of venture capital, times when access to very inexpensive capital sort of
Mhm.
fueled this way of building businesses that were like even much more about top line growth, get it out there, we'll figure out unit economics later. And then all of a
Mhm.
sudden the market shifts and
Mhm. Yeah.
you've got to go raise, having built a company a certain way. And by the way, I'm just kind of like
Yeah.
reading the tea
Yeah.
leaves. And so I'd love to hear a little bit about this idea of like, yes, you're always running your company and you have your eye on cash out and runway. And there is this time when people are like, ooh, I'm looking at things and we got to go raise. What was going through your head in kind of call it late 2022 and 2023?
We had launched a product. I built it. So we raised the Series A. I built a completely new exec team, brought on head of
Wow.
finance, brought on a head of product engineering. I was, we were going for it. Brought on, like, started thinking about, go to market, and spent all of 2022 building, shipping, getting customers to come in and beat up on the product and give us their feedback. And we were seeing great growth. We went from 0 to 900,000 in 3 quarters, and we were feeling great. And we entered Q1 of 23 with the idea of raising a Series B. And SVB crashed. Everything started to crash. And it became, and to your point, the sensitivities around what traction meant changed right under us. It wasn't just about the growth. It wasn't just about incredible growth. It was about unit economics. It was about, if you're going to raise in this environment, here's what we have to see. So we went out and talked. We had hundreds of conversations with VCs. No one knew what their ability to write a check was. I mean, it was tumultuous. It was
Scary times.
tumultuous. So scary times. So we were, I had really sober conversations with my board, and my advisors and my team, and spent a lot of time just talking to people and saying, what do you think? What are the chances of raising a Series B right now? And for the most part, reality set in, and everybody said it's pretty low. You might want to start thinking about some alternative options. And so we decided to reset our expectations, focus on our unit economics, just from a business efficiency standpoint, just making sure we were running a solid business ourselves that we felt we could justify. And then we reduced the amount we went out to raise. We changed the profile of the people we were talking to. We changed the letter of the round from B to kind of like A prime, and we went for it and didn't really turn back. I will say, I'm grateful for one thing. When we raised in 21, like you said, heady time of the market, also for valuations. And when we raised our Series A, we got a lot of pressure from people around us to take the term sheet with the highest valuation.
Mhm.
And there was quite a fluctuation in valuations. And I was really stubborn about that. I prioritized partner over valuation. I said, I get it, like, less dilutive, better valuation, but don't totally jive with the partner. Not quite sure I want to build with that person. I'm gonna go this way instead. And in 2023, I'm so glad I did, because a lot of these valuations didn't hold in the new market, right? And that put founders and founding teams and all of their shareholders in a really, really tough spot from a down round perspective and otherwise. So that's another part of this. That's just, values change, and you got to be sober with yourself about what you think you're worth. You have to be able to justify, looking at your business, what you think you really can do and grow into.
Yeah, I mean, it's cool that you made a very good decision, but maybe not necessarily where you thought a lot of it would come into play. You picked a partner who in some ways people might have been like is not really giving you the best deal, but a very good lesson to learn. And I wanted to kind of wrap up this part of the conversation and say, like, when I was working alongside founders raising capital in 2023, a lot of what you described was happening to everyone, right? The rules of engagement were kind of shifting outside of people's controls. This expectations were moving underneath people's feet, right? It was like 6 months
Mm-hmm.
prior, this is what people expected and what people were pushing you to do. And then all of a sudden it's like, well, no, not that anymore. And so
Hmm.
my experience is that like there were a lot of tough conversations, a lot of things that felt real shitty along the way. And
Hmm.
so
Hmm.
do any stories come to mind for you of like, especially raising this last round? What were some of the hardest times for you, either conversations or experiences that you can share?
Yeah, I would say you really, so when you get familiar with raising money and you've raised multiple rounds and you've worked with VCs and you get a feel for the process, you sort of start to understand pick up on where you're getting real signal, like real buy signals from somebody. If they're really kind of leaning in and spending a lot of time with you and bringing other partners to the table to have conversations, you start to kind of pick up. You're looking for, signals, and so you're looking for a certain sense of urgency. There's a bit of a game played back and forth between the entrepreneur and the VC of, how much a little kind of a scarcity mindset and there's a lot of interest, so you got to act quickly. There's a lot of that, and it's a dance between the two, and both sides know that there's the dance is happening. So it's not, it's unspoken rules of the game. In 2023, none of those signals were all those signals were there, but they weren't actually buy signals.
Oh no.
So VCs had all the time in the world. Like nobody was writing checks. So they were first. They had to bring something to their LPs on a quarterly basis. And that was intel and data. And here's how many companies we spoke to in the last 3 months. And here's what we learned about them. Here's the data we got about them and what they're working on, and what they're focused on, and where we think the market's going. So entrepreneurs are just feeding VCs tons of info in the first half of 2023 with no intention of a check ever being written. That went as far as I had a partner meeting scheduled with a very well-known VC firm. I'd been talking to a partner there. She brought in a more senior person. Everything was following the process. And the partner meeting was scheduled and then canceled the day of the meeting.
Jesus.
So it's just stuff like that happened, and it was just so there's shifting expectations, but then shifting tactics too. That's just yeah. So I think it was really like a return to what do I have that's solid? My relationships are solid. My board members are solid. The VCs I've raised from are solid. Where's the ground that this company is standing on, and how do I leverage that in this moment?
Yeah.
And then it was about finding new people too. We raised half of the round from a completely new, very well respected investor, and then ended up raising a little bit more a few months after that from a customer. So yeah, it was tough.
Yeah.
It was a tough year, and then SVB crashed in the middle of that too. So just a lot of uncertainty. And as an entrepreneur, you're not only focused on fundraising, you're also building a business, you're leading a team of people.
Yeah.
So there was great lessons in how to maintain composure during a time that otherwise was just a complete shit show.
Yeah. I mean, I think the feeling of being strung along and then,
Yeah.
final partner meetings canceled. And I think the whole
Yeah.
time, like founders had people whispering in their ears, like people aren't writing checks. This is bad. And so you start having that, like that,
Yeah.
that persona of fear, like started coming out. And that's not what you want when you're fundraising. And, having people say like, I bet you they're not actually interested in, and having those final partner meetings canceled, that's gotta like gut you, right? That's gotta feel terrible. And I don't want to leave
It's
you.
awful.
Yeah. I don't want to leave you stewing in that, because you got past that. Right. And so the other side
Yeah.
of the coin that I like trying to at least highlight is, at some point you find this new investor, this very respected investor who's willing to take,
Yeah.
at what ended up being half the round. Do you remember where you were when that investor like either sent you the term sheet or gave you the word like they were going to commit to this round?
Yeah, I do. Yeah, I do. I was sitting on a bench inside an office in New York at a customer meeting, and they had just gotten off the phone with one of my board members, and as a due diligence call, and he called me and said, "They're in. I mean, they're going to call you in about half an hour, but like they're fully intending to participate in the round."
Dang. What'd that
That
feel
was
like?
yeah, it was amazing. It was great. It was fantastic. It was fantastic. And it was you just oh man, you can never you use the word gutted, great word. that is how you feel, right? You do feel gutted after getting rejected or getting strung along. Like none of these things feel good. But you can't, you're also a salesperson, and you can't let your past failures jeopardize your future successes. So you have to get on the next pitch and be just as energized
Yep.
and just as passionate and just as optimistic about the future and why what you're building is inevitable, and that has to come through. And that's one of those skills, just like waiting tables at a Michelin star restaurant, that even post this company, I mean, I'm bringing those skills as a parent. I have 2 young kids. Like sometimes I'll go through situations where I'm just like, how do I get through this situation? This is like so frustrating and hard. And I just remember like, no, I've been building this like core ab muscle of just total resilience. Like I've been working that out for like 5 years. I got this. Like I'm gonna figure it out. Um, so it's and so then when it does pay off, when all of that work does pay off, and somebody does say like, yeah, we're in. It's fabulous. And especially when they're good people, when you're excited about working with them and they see you, it's a very like you feel very seen in that moment. That's awesome. It's
That's
great.
awesome.
And
I'm
then
glad.
it's back to business.
And then it's
And then it's
back
back
to
to
crap.
building.
Well, now we got to work, but
And then it's back to build. Then it's like, oh shit, I got to spend this money now.
yeah.
Do I, how am I going to do that? What am I doing here? What's the plan? Do I have the right team? Like you have then it's like, you think the hard part's over, and actually that's just like permission to begin.
Yeah. It's always day one, it's like it continues to be day one over and over
Yeah.
again. You want to make progress,
Yes.
and then the timer
Yes.
resets. Well, look,
Yep.
Annalisa, that's been quite a ride for Catch and Release, and congratulations on getting that round raised. And I look back on the different rounds that were raised in 2023, and I feel like it was a really hard time to raise capital, and the companies that were actually able to get that done tend to be some of the best ones, right? And while you might have at some point thought you wanted to raise 2 to 3 times that much if it were a typical Series B, I think you might look back on what that reset did for you, and it might end up being a huge blessing in disguise. So I'm excited to kind of see where Catch and Release goes. When we end these conversations, I always like to ask a fun question, but Catch and Release is working on helping people access content and license it, just in time or whenever they need it. Any stories about the weirdest or funniest pieces of content that have been licensed on the Catch and Release platform? Anything that you can share that, PG-13 maybe?
Yeah, absolutely. I mean, there's lots. Well, I will say we did license a piece of content once for a brand, a large healthcare brand, and it was a video that we'd found on YouTube of a man proposing to a woman, and he was a paraplegic, so he was in a wheelchair, and he proposed to his fiance, and she said yes, and she's captured on film. And our customer wanted to license it, and we've created this marketplace as you suggested for licensing, and we often end up surprising people with, hey, a brand saw your video and they want to pay you for it, and putting money in the pockets of regular people who aren't necessarily waking up in the morning expecting that is kind of fun. And what we learned is that they used because of his condition, they were unable to get pregnant, and so they used the licensing fees to help fund IVF.
Wow!
And she got pregnant 9 months later and sent the company videos of their whole pregnancy and experience, and it was such a pay it forward moment from a content perspective.
Wow.
It was really cool.
That's an amazing story. That kind of made me tear up a little bit. That's really sweet.
There's a lot of those. Yeah.
Well, Analisa, thanks so much for the conversation. Lots to share, lots of things for people to sort of draw inspiration from. So appreciate your time.
Thank you. This is a great topic. I wish this kind of resource was available when I was in the early stage of fundraising. I had to go figure it out on my own, but this is an amazing resource for people who are venturing into this world. So thanks for doing it.
That was my conversation with Analisa Goodin, founder and CEO of Catch and Release, one of the top content licensing platforms for brands and creators. I hope this episode allowed you to walk away with more knowledge on what it takes to become a venture-backed company on your own terms. After the break, I'll be sitting down with my producer, Paige, to hear her thoughts on the convo I just had with Analisa. I get it. Trusting your pitch deck to just any designer can be nerve-wracking, especially when it comes to fundraising. That's why we've created Adamant Deck Design, where amazing design meets fundraising expertise that you can rely on. We design your deck up to 15 slides, give you 2 rounds of feedback and revisions, and even add 3 bonus template slides for future work so that you can creatively customize your deck without us. Throughout your redesign, we incorporate design thinking proven to be effective in Adamant's fundraising work. If you're looking for more detailed work around your story and narrative, make sure to check out our Design Plus Story Engineering tier. That's an add-on that a lot of people love. You can trust Adamant Deck Design for your fundraising success. Just head to admnt.com/deck to learn more and reach out if you'd like to work with us.
Hello, Jason.
Hey, Paige. How are you?
I feel like it's so scripted. I have deja vu every time we say that. Hello, Jason. Hi, Paige. We got to switch it up. But I'm happy to have this little chat, this little debrief. I feel like we've been getting a good variety of different types of guests and different focuses within fundraising and how people approach them. So the reason I was kind of excited about this episode is I appreciate how it has this focus around running a service-based company and starting out and then realizing like, oh shoot, like there's really something here. There's a problem that a lot of people are trying to get solved. And for Analisa, she was trying to figure out along the way, could we transition this into being a product that's scalable? And I found the conversation super interesting around that because something you do talk about a lot as well is you got to figure out first if your business is even able to be venture backed. So it was cool to kind of see her share her thought process behind it and some of the tactics she used to figure out if it was a fit.
I honestly, I really love this too, because in a lot of scenarios, this is the approach that I give entrepreneurs. This is the approach that I advise entrepreneurs to follow, especially when there are people that are like, I want to start a business. I don't really know exactly what market I'm going to be in. I don't know exactly the problem I want to solve, but I really, really want to solve a business. This is advice that I got from my close friend who's like a fantastic entrepreneur when I was also like just dead set on starting a company, even though I didn't have the right thing to do. I didn't end up following this advice, but his advice was you should run a consultancy. Like you should be a consultant to companies in spaces that you enjoy or that you have some passion around or you have some expertise around. By being there and like solving problems for them, the problems that might not be the thing that you end up doing on a bigger scale with software, but by being like so close to the customer, you get a chance to see other problems that you might actually be able to solve with software. So, the fact that she was able to run a real business, actually solve problems, while there might be a like complication around this idea of like, well, how do I convince investors that we'll be able to build a product or the product will actually be scalable or a number of things? There's one thing that she doesn't have to convince people of or doesn't have a hard time convincing them of, which is that she's validated the problem space.
True.
Like she's been solving the problem, but she's been doing it manually. A lot of founders, especially at earlier stages, they struggle with the fact that they're saying there's this problem, but like they don't have enough there to show that like there actually is a problem. Is someone actually paying for you to solve the problem? That's how we know that there's a problem worth solving. So yeah, I love this as a description because it can be a roadmap for some other founders. And in some cases it might not lead to raising venture capital, but that's also okay. I think that's totally cool.
Yeah, I think those are some solid points. I think I personally haven't heard of that many, I guess, roadmaps that are like this. Like, or I just haven't, heard many stories of founders who have this like service business that's all manual that are trying to make this jump because it's a really hard and intimidating jump, especially because she was saying like she was building the company, she wasn't building the product when she was figuring out how to raise. So I found that interesting as well, and I kind of wanted to double click on that and ask like she had around $1 million in revenue when she was thinking about going out to raise, and she was making the point that revenue from a service isn't really that attractive to VCs because you haven't proved that you can make revenue from a scalable product.
Right.
I guess like I don't know if you just have any thoughts on how someone can convey that within their, like, I can't comprehend how you do that, because you've proven that you can have a successful service, but how do you, I guess I'm like trying to figure out how you make that jump or convey that jump to investors.
Yeah.
I don't know. Yeah.
No, I think it's like, it's something that comes up a lot where I'll see founders following this model and they're like, look, we're already making X dollars, X million dollars or however much it is. And then they want to go raise money at a valuation multiple of that. And, to take a step back, when we think about how companies get valued at the earliest stages, it's very finger in the air. It's like, what does it feel like? And we use these things called valuation multiples, which are like, can we take your annual revenue and multiply it by 15, and that's what you're valued at?
Yeah.
That's kind of what people hope they'll get off of service revenue. But if you think about what a venture capitalist is doing when they're valuing a company, they're like saying, is this company today going to be worth something more in the future? And the revenue is an indication of like how likely it is that the bigger version of the company will come to be. And if you are running a company that is like generating revenue in one way, but you're saying you're going to do something completely different, then can't really give you that, we can't give you credit for that money, because it's like, it's not the revenue that we need to expect for the future. It's like similar, but very different. I think the only thing that a founder can do is say like, well, look, you don't have to give us a revenue multiple on this, but you're going to give us credit for all the work we've done to develop the customer, the brand, the validation of the problem space, the team, and that revenue, while we won't get a revenue multiple, you're going to give us some credit for all that we've done. And in
Yeah. Okay.
terms of what you need to convince a VC of being able to make that transition is, look, if you haven't started building the product, there's a lot of trust that you're going to have to develop with the investor, belief in you, and have that be combined with like just a really exciting opportunity. Because at the end of the day, like it's a big risk. It's like, well, yeah, they validated a problem, but are they going to be good at building software? Like, do they know how to do that? Have they
Yeah.
done it before? And there are so many ways and reasons that software companies can fail, especially if you're not experienced at that. But I think in Analisa's case, it's like, it's selling the bigger story so that all the risk is worth the reward of like, oh my God, this could be massive, so we should try.
Yeah.
And then I think you can tell a story, or you can demonstrate that I've done so much to run a company that has a lot of complexity to it. We have this number of employees, we have these clients, we have to do these things. Yes, software is different from what I was doing before, but in a lot of ways, management of a company that's building software is not so different than managing a company that's building other things. I, of course, can do this. I can apply my management and team skills to this. And it's not like we're replacing the whole team. A lot of the team that works together, executes together today will be pointed at this. We'll just be adding software engineers. So obviously there's always going to be twists and turns and stories that you tell. But if the story is compelling, you can make that leap and, convince an investor to back you on that transition.
Yeah. Okay. I like that. I think that helped bridge I just couldn't even wrap my head around, like, because they are kind of two completely different things, but it is always a risk regardless in an early stage company. Like, especially like, I think she was going out to raise her seed, but in case of a pre-seed, most of them don't have a product. So
Yeah.
they don't even have, that, I don't know. I'm looking for the words,
Product market fit.
product market fit, or like validation. See, I'm
Yeah.
getting there.
Yeah.
They don't even have that. So in her case, at least she does still have something that she can kind of intertwine and tell this story of how she's going to apply it to the next phase of their company, which is cool.
Yeah. Totally. And one other thing I was just going to add in there is that it's kind of also like a negotiating tactic for an investor to say, look, I know you were making X million dollars a year, but you're doing something completely different from what you're saying you're going to do. And so like, we can't really give you credit. Here's what the valuation will be. But in the back of their heads, they're like, it is very impressive that you built this big business. And by the way, the skill it takes to build a multi-million-dollar business is like, it takes significant skills. And there's a lot of just pure operating and pure team management that goes into any company. And companies should get credit for that. So look, it's a venture capitalist job to get a great deal whenever they can. And so even though if they're in the back of their heads, they're probably like, man, Analisa would be great to back. She's going after something great. They're probably still going to try to play the card. Well, I know you had this amount of revenue, but like, we can't give you credit for it, and just have this sort of back and forth to get it to a valuation that they feel comfortable with.
Yeah. I mean, and clearly though, like she got her credit was due because she
Yep.
did execute and raise 3 successful rounds. And what she mentioned was a lot of the investors that were a part of her first round went on to raise or be a part of her next 2 rounds.
Right.
And I had a question around that. It wasn't even because of her episode, but I thought of it. Is that like, is it common to have the same investors stay in the next round? And if they don't, is that always a bad thing? Or is it because like there's something else? Because I know that they stay on the cap table regardless, I think. But like, yeah, I just don't know where you draw that line. Like, is it always a bad thing, or is it because maybe they have to put their funds elsewhere and they don't have, I don't know. Is it always like a red flag or?
Well, you've seen me do this page with other founders where like, I don't answer the question right away. Like, what do you think? What are the bad parts about that? And what are the good parts about that? Or
I mean, I think that if there's a reason, I think we just touched on this actually. I think that if there's a reason that they can't, that like genuinely stops them, then that makes sense. But
Yeah.
if there's no reason and they're just saying, "Oh yeah, we're gonna sit this one out," that's kind of sketchy. But at the same time, they still are on the cap table, so they're like, I don't know. See, this is where I get confused because
Yeah.
maybe I don't understand what it means to be on the cap table and how involved that makes you in a company.
Yeah. Well, I'll just say, your initial instincts were exactly correct. I mean, anytime an investor has an opportunity to invest in a company that is seemingly a good company, then they should invest. And people that are already on the cap table. So being on the cap table just means that you own equity. And the only time you get off the cap table is if you somehow get rid of that equity. And by get rid of it, it's usually you sell it to somebody else. Somebody else buys that from you. Either the company buys it back or you sell it to another investor.
So when Andre had to regurgitate his cap table, that's kind of what he was doing. He was like, he was either like buying them back or selling them to other people.
Yeah, in some cases, you buy people out. You take them off your cap table.
Okay.
And in Andre, we're talking about the Incognito episode. Some of it is essentially they're still on the cap table, but you do something called recapping a company, where you kind of cram them down, is the term, where you raise a round at a very low valuation so that existing investors get diluted to a very small amount. Anyways, but yeah, there are different ways to get people off the cap table. The thing I was going to say about your instincts here is that if you are already an investor, so already on the cap table, and part of your mandate as a fund allows you to invest in later stages, as in that's part of your strategy, well, then it's really important for you as the founder to be able to get those investors to invest in the next round, because the people on the cap table, the people that are closest to this business, should know if it's a good business or if it's a bad business. And if they aren't re-upping, if they're not like at least investing what's called their pro rata, then it's an indication the investors that are looking at the next round are going to go to each investor and say, Paige, you're not investing in this round. Why?
Oh.
Right. And if you don't have a good answer, then it's a very bad signal. The answer could be, we're out of capital. We actually don't have any capital to invest. It could be, I mean, there are a few other things where it's like, we already got the ownership target that we need, and we're happy to have other people take it. That's not as good of an answer, but it's a little bit better of an answer. And so, yeah, it is a signal that is very important. So the fact that she had so many investors come with her in every round shows that they like what they're doing. They saw what she was doing when they wrote their initial check and liked it. as they kept growing, they continued to like it. So every opportunity they've had to invest, they've continued to back it.
Damn. Yeah, thank you for clarifying that. Yeah, I've just found this story particularly so fascinating because she just kind of grew up so outside of all of this.
Yeah.
And she used, like, she was more in like the artistic world, and she used that strength of like being an artist and being creative and then applying it into venture capital, which is just so interesting to see. Like, she utilize her strengths of like talking to people and networking, and just, I think she said she started off networking just with anyone. So anyone who would grab her grab a coffee in SF, which could be a wide variety of people. And then that person might know someone, and then you slowly make your way. I just think she's genius. And it was so cool to see her execute on this, because it might be easier for people who have a service business, like, not be able to envision themselves making that jump. So I feel like this episode gives a good opportunity to show people, like, yeah, like, it actually is possible. It's not easy, but yeah, it's cool.
I think showing, this is what we're all about, telling the story that it's possible for anyone, and, putting in the effort, no matter what you come from, what type of person you are, what your strengths are, like, is certainly possible with the right amount of effort. So I think that's the debrief.
I was waiting for you to say it this time. I always say it.
I think that's the debrief.
That's the debrief.
Amazing. All right. We'll see you next time. If you're looking for more insights, strategies, and support around fundraising, subscribe to our newsletter. It's at fundedpod.com/newsletter. And find me on social. I'm at Jayeh, that's JAYYEH, on almost every platform. I respond to DMs and newsletter replies, so hit me up. This episode was produced by Paige Randall.
Hey, guys.
Thanks also to John O'Lee from Adamant.
Hey, everyone.
And as always, one last thanks to our sponsor, Vanta, the leading automated security and compliance platform.